Good afternoon, everyone. Welcome back from the break. In this session, we'll be talking about a panel that we have on the role of cybersecurity insurance in cyber risk management. This is going to sound like a really strange episode of Connections, but what does a coffee house in the 17th century England have to do with the topic of this panel? Well, as it turns out, that's where Lloyd's of London was formed, one of the earliest in the business of insuring ships that carried expensive cargo. And people soon realized they needed insurance for their expensive cargo should something go wrong with their ships. And the modern day analog of infrastructure that carries expensive cargo is the internet, things that you guys are all involved with. So kicking that off, folks we have on the panel represent a variety of different organizations. They're the underwriters, the brokers, as well as folks who are involved in what happens after something has gone wrong, the breach response folks as well. We have on the panel today Oliver. Oliver will be moderating the panel. He works at Liberty International. We have Mickey Esty, who's at RT Specialty. And Laurie Floresca from Woodruff Sawyer. They're both brokers in this industry. We have Thomas Kang from the ACE Group, also an underwriter. And finally, Winston Crone from Kiva Consulting, who deals extensively in breach response. So, Oliver?
Thanks very much, Manish. Delighted to be here. And as Manish said, when we come to conferences like this, it's not very often that we feel that as insurance people, we're normally the kind of the geeky ones in the corner talking to each other about the specifics of certain insurance contract language. But it's great to be here, and I realise this is maybe a new topic for many of you. So to aid your understanding, do feel free, if you have questions throughout the session, do please raise your hand, and you can see the microphones placed around the room. So just to embellish briefly on the introductions, Mickey is on my far right, is an insurance broker based out of San Francisco, and Laurie is also another insurance broker. Keep them together to compete with each other or something. Also from San Francisco, Woodruff Sawyer. And then on my left, these are the people who deal with the aftermath. So Winston at Kiva Consulting on the forensic side, and Tom Kang runs the claims group at ACE. So with that, we'll get started. The topic of insurance is always one that very frequently comes up in discussions when it comes to protecting assets. And as we heard, insurance provides coverage for ships, and I'm sure all of you have house insurance and car insurance and business insurance. And now one of the most valuable assets in all of our organizations is the data itself, rather than the physical apparatus. And obviously you don't need me to tell you that. As a group of technologists, you're very familiar with the evolution and revolution that's taken place over the last 20 years when it comes to things like data storage, the speed of transmission, and all of these factors that have really accelerated massively the connectedness and therefore the ubiquity of data and our reliance on it as a society. So today we're just going to run through some high-level topics just to introduce the subject to you, and go through some of the history of it, the drivers, why the market has grown to what it is, what are the threats that we're actually looking at, the insurance process, so how do you actually buy insurance? And we've heard, talking to some of the panelists earlier, that people today, even though the market is 15 plus years old, people are still raising their eyebrows and saying, you mean you can buy insurance for this? And maybe that's a question that I'm nervous to ask a group like this, because you guys probably know far more about it on the front lines than I do. Then we'll look at some of the breach response issues and what actually happens when a claim takes place and an incident occurs. And Tom is going to share some, I should say, anonymized claim scenarios that he's actually dealt with and written some pretty hefty checks for. And then we'll look finally, if we have time, about the future of the market. So, going back to the early days of the internet, And back in the late 90s, when I started out in this industry, the first, what was known as the internet liability policies were written out of, guess what, Lloyd's of London, Manish. The policies were very specific, very limited in scope, and frankly, it's not that surprising, given that although we're in the business of risk, there were so many unknowns compared to some of the more familiar insurances like hurricanes and even though these big volatile risks, we had 100 years of data, or life insurance. Think about that as a comparison. We didn't really know where to start. So these started emerging in the late 90s. And then, of course, Y2K came along, and that was a huge catalyst to get people focused on the issue of technology as a potential solution in terms of building robust infrastructure and not just looking at some of the threats about it. Then the dot-com bubble, of course, came and went, and the only real companies in this era buying specific cyber or what was called e-commerce insurance at the time were really pure internet play companies. So it didn't really take off in terms of mainstream as a mechanism for risk transfer. And then this is where us insurance nerds get excited, because the regulations have been driving a lot of this growth. And in 2003 in California, there's a bill called the 1386. This was what became the first notification law. So that meant that if you had a breach of customer data, you had to physically send them a letter. And that all of a sudden got very expensive very quickly when you add up the numbers. And so that led to some of these breaches, which I'm sure many of you are familiar with. The poster child in the late 2000s, of course, being TJX, where they had 43 million credit card numbers stolen. And these breaches just kept rising, and the costs associated with them grew as well. And depending on the industry, there were a whole range of different regulators and lawyers chasing this type of business. And HIPAA, for those of you who may interact with the healthcare sector, came out with some very onerous obligations in 2013 relating to both the notification duties in the event of a breach, but also the security and privacy obligations for covered entities, as they're known as well. And I guess I'd look back at the last 15 years and you think, well, how far have we really come? I guess I would like to offer a comparison. Auto insurance, as we know it, is very commoditized and sophisticated in terms of what make and model of car you buy determines the price you pay and that kind of thing. But obviously cars have been around for decades. I think the Model T came out in 1903. There weren't really meaningful insurance policies until the 1920s and 30s. So I think we've made a lot of progress in a short amount of time. So the market is taking off dramatically in the last 3 to 5 years, certainly. And obviously all the publicized breaches of cyber espionage and hacking is certainly fueling the fire when it comes to companies being concerned about these types of risks. But also the ramifications of those breaches are that lawyers are now getting smarter, and the legislative bodies are creating more obligations and creating increased regulations as well. So they are also adding to the burden for companies. But on the plus side, the boards, company boards are recognizing that it is the right thing to do, that managing your risk is not just an IT issue, and it's now being integrated more into the broader risk management policies. And so the board risk management processes are now helping companies when they're talking to their vendors and their business partners, what are the issues that they should pass on either by contracts or through technology means, so that the company, the risks are being spread out through the business partners that they're working with. So in terms of the data breach history, I don't know how much detail you can see, but just the chart on the left shows the number of events over the last 10 years, and the chart on the right shows the total number of records impacted by the types of breaches. And you can see at a distance, obviously the trend is only heading in one direction. I would just point out that the top number there on the right-hand side is 450 million records were breached in the US alone in 2013. In terms of the types of industries impacted, well, again, it's a whole range of different sectors. The four I've highlighted there are the perhaps the most obvious given the types of data that they hold, these are really the biggest areas when it comes to both regulations and from the threats that they're seeing from hackers. So, Laurie, tell us about some of the cyber risks that you've encountered talking to clients.
Sure, and I just want to start by giving some big picture. When we use the term cyber insurance, what does that mean? It's actually not a defined term that is consistent from insurance company to insurance company. So we give some big picture comments on what we're talking about. I mean, first of all, focusing on the right side of this chart, the common exposures that companies are looking to transfer and are able to transfer to an insurance policy. The loss of customer data is obviously what gets so much publicity. That's where the big breaches have been. That's what we're talking about in Target. That's what eBay's problems are in the last couple of weeks. Certainly credit card data, social security numbers, health records, but even in California last year, the definition of PII, personally identifiable information, was expanded to include login credentials. So now we've got a much wider net of companies, social media companies who don't really collect much data, but they have a login, email address, and password combination that is now subjects them to more regulatory scrutiny if they have a breach. Employee data, every company has that. Obviously, it's just a matter of size to whether that's a meaningful exposure in terms of dollars to deal with a breach. And then the last category, loss of profits. The cost of the extra expense and the loss of income for a company when a network security failure brings you down. And we're not talking about the loss of future revenue from reputational harm because your system was breached and your customers don't come back. This is if your network is down for 3 days and you can't transact business, you can't operate. You can transfer that risk. You can get business interruption insurance for those costs. The aspects of the cyber risk that are not covered are things we think about, like the lost value of intellectual property. Not good risk management solutions for that right now. So your own intellectual property that you're storing on your network, there's not an insurance metric to value that and to provide financial loss from that, as well as loss of future revenue and reputational harm. There are insurance products in the market that will cover those things. They're more cutting edge. But when you're talking about a standard cyber insurance policy, we're mainly talking about data breach and the business interruption, the loss of profits arising out of an event. Some of the things that we hear from our clients and that we're constantly talking about are the risks of the cloud, using third-party payment processors, how all that fits into to cyber exposure. Generally, you accept a credit card, you take consumer information, that's your obligation, that's your responsibility, whether you're storing it in the cloud or with a third party or not. So the original responsibilities rest with whoever was taking that information. And also the cloud vendors, as a lot of you know, if you're sitting in the audience, are pretty successful at limiting your liability in those contracts. And so most cloud vendors are not accepting much risk in that. So we're always talking to our clients to make sure that you understand that these are going to be your costs. There is going to be little to no recourse generally against third parties. I'm going to move on to the kind of big picture of what the cyber policies cover, and a couple of key points to make here. I talk to my clients about two different buckets of coverage: network security and privacy. And the reason we separate those is privacy does not have to be a network security exposure. So in privacy breach, we're talking about things about exposing data, which could certainly come from a failure of network security, but it could also come from a lost laptop or device. It could come from physical records being improperly disposed of, left in a dumpster. Either way, we're going to trigger coverage under these policies for the costs associated with a privacy breach. The network security piece is also going to cover things like transmission of virus, impacting somebody else's network, the business interruption we talked about, things like cyber extortion, where somebody claims to have access to your network and they're going to harm it or to release data if you don't pay a ransom. Those things are going to trigger under a network security cyber policy.
So, Laurie, these types of risks, they would cover paper records as well?
Yes. And we see those types of breaches a lot, especially in the healthcare industry. It has a lot more paper than more of our technology clients. And the other key point, to go back once quickly on that, Ollie, those buckets are talking about first party versus third party. That's an important concept to appreciate. This is kind of unique in this part of insurance, that these policies will cover both the direct costs that a company incurs when they have a network security failure, and also the liability arising out of it. So when I talk about first party and direct costs, those are things like the forensic IT to come in and figure out what happened, what was the extent of the breach, how long were they in, how much data did they have access to, the legal advice that companies need at that point as to what their obligations are, PR, the cost of notifying customers, potentially offering them credit monitoring insurance. All of those things would be direct costs that a company incurs before anybody even knows you have an event. Then you have coverage on the third-party side, the liability arising out of it. These are the demands from state attorneys general, from your regulators, depending on your industry, the cost of lawsuits defending. Target had 68 lawsuits filed in the first month after their breach. So all those things would fall under the third-party piece, including fines and penalties related to cyber breaches. So really the whole event, there's a lot of coverage available in the insurance market right now.
So those plaintiff class action lawyers are keeping themselves busy.
They think this is the new gravy train. I think we will continue to see, it's funny because we have a lot of consumer fatigue on this topic. I mean, how many letters can you get in the mail saying that your personal data has been lost somewhere? And really your ability to figure out if you have identity theft, which breach it came from, is pretty difficult. But the regulators aren't slowing down in this space. And so the more oversight we see in that is going to make this problem more burdensome for companies, I think, over time. So there's a lot of insurance available right now for large companies that have tens and hundreds of millions of consumer records. They're looking at insurance programs, 200 to 300 million in limits for the costs of that, dealing with those breaches. And just to give you some numbers, the Target breach we've been throwing around, the expectations are they could spend several hundred million, approaching $1 billion in direct costs related to that breach. So the scale of these things for a very large company is significant. The first party, the direct costs we talked about, not all policies cover that all the way to the limits, and so that's another thing that companies are really trying to figure out is how much of this insurance do we need, particularly how much to cover those direct costs like notifying customers. But you can buy a lot of insurance here if you want it.
So let's change tack and ask Tom on the claim side. What do you see the threat issues from your perspective?
Thanks, Ollie. There's a slide, I think, further down the line where we discuss the specific triggers and specific events that lead to privacy and network security breaches. So I won't spend a whole lot of time here, but I think there is a connection. You see, obviously, these are the list of items that potentially pose a threat to any organization from a privacy and a network security perspective. I think what's interesting to me is that the internal threats and external threats are intricately linked, right? So, for example, about 24% of our claims that we've seen, incidents that we've seen, probably since 2005, are related to a network security event. Well, within that 24%, vast majority are simple phishing attacks or poor password management. Well, what is that? It's basically an insider, an employee, failing to take the proper precautions to secure the organization's information. So I think there's a lot of interplay between the internal threats and external threats. That said, I think initially when this coverage was relatively young, we saw a lot of just lost laptop situations or simple human error situations where people are sending emails with attachments and so forth to the wrong recipient. A lot of that I think has been addressed and has been mitigated to a large degree by many organizations. That said, these days we are seeing a lot more, and I'm sure you guys are aware, external threats, network security events. I think, as Lori mentioned, the biggest driver in this space is the regulatory regime. She mentioned some of the obligations and costs incurred when there is a breach. A lot of that is due to regulations that are out there. So, for example, a lot of the breach notification statutes do require you to notify folks when their PII, personally identifiable information, has been compromised. So that is really the biggest driver. Now, there are, I think anytime you talk to a regulator, anytime you talk to, folks within this industry, they'll tell you that the regulators are becoming much more aggressive in this space, whether you're talking about the state AGs or the FTC or, the Office of Civil Rights and Healthcare. But there are a couple of things I think most regulators are really focused on. I think they all understand that they're not looking for perfect security. They all understand that unauthorized events, privacy events, will happen. What they're looking for is that organizations really understand the privacy exposures that are out there within their organization. They've conducted some type of analysis to address that risk, and that they've taken affirmative actions to reduce those risks. So a lot of the fines that you see that we just talked about, those are assessed generally when an organization has not identified the risks, do not have policies and procedures in place. It's not necessarily related to the size of the event. So for example, we had an event that involved more than 2 million records. The regulatory fines connected with that was less than 50,000. So it's really not about how big the event is from a per record perspective, but whether organizations have actually taken some analysis and gone through the risk and gone through some steps to address those risks. Litigation certainly is on the increase. Litigation these days, obviously there are a lot of litigations related to data breaches, but we have seen, and last time I checked, there are over 230 class action litigations related to the collection and use of personal information. So for example, one of the primary cases out there has to do with Hulu, and how they use the like button and how they collect information about the viewing habits of their audience with respect to particular videos. So there are a number of different statutes out there that regulate how you can collect and use information, and that has been probably one of the most active spaces in this industry.
So when it comes to the actual, potentially the weakest link, Mickey, what's your experience when you're talking to clients about their employees? Well, talk us through this cartoon.
As long as the password 12345 is out there, I think we're going to have problems. I did see a really interesting seminar. The CIO from Intel a couple years ago, I saw him at a seminar, and he had this slide called the 5 Irrefutable Laws of Security. There was a lot of interesting things on there, like software code wants to be wrong, other things, but I think my favorite one was people want to click on things. And based on the fact that Winston's business, I think, just continues to grow, I think people are going to continue to click on things. So I think human error is going to be with us for a while.
Good. And so Winston, when it comes to hacking, you're in the forensic business, so your daily life is living and breathing the kind of external threats. What are you seeing in your experience?
Right. Oh, the push button. I guess I'm the only person in this room who doesn't like to push and click on this. From bitter experience. I didn't write that. The words, the glamorous threat, I don't find hackers glamorous. I think they're sad, low-life people who destroy people's careers and waste a lot of organizations' money that could be better spent doing other things. Last year was truly the year of hacktivism and organized money grabbing. Right up through November, it was going to be the year of political hacktivism from Snowden to Syria to Russia to China, and then in December, Target happened. And so we left 2013 thinking of it as the great retail year, but both things were pretty egregious. The only real difference for us between hacktivists, political hacktivists, and organized crime is that hacktivists want to get into your system. That's their goal, and they'll keep doing it from now until forever. It's really just a question of time whether they'll get in or not. The organized crime and criminals are after the money. You just mustn't be the slowest antelope in the herd. They'll find somebody else to do it.
And in terms of, what are your thoughts on state-sponsored events? I put a question mark on...
I'm generally against it.
I put
both
a
our
question...
countries and other countries.
I put a question mark on this slide, but perhaps given the recent indictment issued by the DOJ, I can delete that question mark. Anyway, so hacking clearly is a major external threat, and I'm sure something that takes up a lot of your time when you're thinking about network issues. But as Tom said earlier, I just did want to touch on some of the regulatory issues, and it is very much both sector-specific and horizontal, both by geography and jurisdiction. So I won't go into too much detail on these. Suffice to say that if you are in the healthcare sector, or if any of your clients are in the healthcare sector, or if any of your clients' clients are in the healthcare sector, then this matters to you. Because the final rule, as I mentioned at the start, impacts everyone who is what is known as a business associate of healthcare covered entities, and also their subcontractors and their subcontractors. So the whole ecosystem is now has these direct obligations under HIPAA and high tech, and that does now have certain obligations and allows things like state attorney generals to bring civil actions as well. The FTC, of course, many of you are familiar with the Federal Trade Commission and their authority under Section 5 of the FTC Act, which enables them to bring actions against companies. And the issue for them is there have been so many companies who have had problems when it comes to data security and privacy that right now, as Winston said, to use that analogy, you only have to be the least bad to avoid being in their radar. And then the credit card area is the other obvious exposure from a regulatory perspective. Now, interestingly, this is not necessarily a government body so much as an industry body. So this is basically the oligopoly that is Visa, MasterCard, Amex, and maybe Discover, if you're being generous. And these card brands run the show when it comes to the contracts you have to sign, the indemnities you have to give over as a merchant. So anyone accepting credit cards, whether in a store or on the internet, has very specific industry obligations relating to privacy and security.
I would only note there that some of the merchants are pushing back to some degree, obviously with varying degrees of success. If you are a large retailer, then certainly you may have a bit more leverage in your discussions with Visa or with the MasterCard. So, I do want to note and highlight that some of these fines and assessments are negotiable, but in very rare cases.
And the state notification laws we've touched on already. So I want to make sure we get through as much of the material as we can. And just a quick reminder, if you do have any questions, feel free to shout out as we're going along using the microphones along the aisles. So Mickey, perhaps you could talk us through, just in high-level terms, what does the process look like for a client who has never heard of this insurance but thinks it's maybe a good thing?
Absolutely. One thing, Lori and I will say this over and over again for this, particularly with this product, is get started early when you want to purchase this product. The reason is it takes time. For the first bullet point, you're going to want to make sure you involve senior management, and the underwriters want to see that. Some of you in this room may have been involved in purchasing a cyber product where you're brought in to talk to the underwriters, explain your risk management processes and controls that you have around network security. To get everyone schedules together, get the underwriter schedules together, it takes time. You want to make sure you get started and leave enough time for that. One of the things you'll see, and a lot of times this will happen in the financial function of the company, they're going to do a risk management analysis. How much risk do we have in here? How much money do we want to spend on network security type costs versus how much should we spend for buying insurance? Should we buy 10 million, 20 million? Making those kind of cost benefit analysis are things that companies are going to want to do, and that takes an early start on the process. There's a lot of different, obviously, audits and different things that people have to go through. The underwriters are going to want to hear about that. So if you get called in to do one of these meetings, be prepared to kind of talk about how you're complying with these audits, which audits you comply with. All those things will be what underwriters are asking questions about. We have complete application in there. A lot of times it takes multiple people to get that done. That's another reason to get started early. And then I actually would insert another bullet in here, after the complete application, and that's for most of the larger companies in this room, is you're going to meet with the underwriters. And this is where, Lori and I come and where we're involved in the process of setting an agenda for the meeting and getting ready for that meeting so we have a good meeting with the underwriters to present the best face possible. We definitely don't want to shock or piss off the underwriters. Don't you think that's a good idea, Ollie?
So you mean that it's not always the warts and all story that we hear?
Well, I'll give you a short example of this is probably what you don't want to do in a meeting. So we were in this doing an underwriter meeting, and one of the I'll call them inquisitive underwriters, much like Ollie, asked a simple question: have you guys had any breaches in the last 24 months? Well, turns out this client decided that they were going to announce not only to all the underwriters on the phone, but to the brokers as well, that yes, we did have a breach 6 months ago, and none of us knew anything about it, and it affected about 100,000 people. So needless to say, that wasn't the way we were expecting the meeting to go, but it happened and we dealt with it and we got some insurance for them.
And one other tip from my experience is that if you are getting involved in the insurance process, it's never a good sign if the technology network guy is meeting the risk manager guy for the first time when you walk into the room, and I've seen that happen as well. Quick show of hands, if I may, just check we're all with this. Is anyone here been involved in the insurance process at your organisation? So a smattering.
Just a handful, yeah.
That's interesting because I think as this topic and this issue becomes more and more mainstream, I think that that number will continue to grow. So in terms of the underwriting issues, Mickey, what do you think are the biggest priorities when it comes to what the end product looks like for each client?
Yeah, absolutely. So, when Lori and I work with the underwriters, obviously we get involved in hearing from them day to day about what they look for in a risk, what they're trying to understand about the risk. And these are kind of some of the typical factors that companies use when they're rating up a policy. This is still a bit of a, lick the thumb and put it in the wind to guess the premium. There's some different metrics that we can try and use, but this is still a learning process for the underwriters of how to measure this risk, how to price for it.
I'll let that comment slide.
It's very scientific, I meant. So, industries, obviously the industries with more exposure, they tend to rate them higher for risk and for premiums. So financial, technology, healthcare, retail, those are all factors that tend to weigh more into rating up the premium. The size of the company, their revenues, how much data they have, the kinds of data. Because what we've seen in a lot of these breaches, the costs of the breach tend to scale with the amount of data that's been involved. That's the main reason that they want to know the amount and types of data that you have. As we talked about, there's going to be an underwriter meeting. They want us to understand your process, the people, the team that you have involved and what they're doing. And then from an incident response perspective, a lot of these policies allow you to work with certain outside vendors, and that's something that you're going to want to work with the underwriters and the carrier to get agreed to in advance, so if there's a forensic firm like Winston's that you're going to call to come in when we have a breach, make sure you know who that is or get it agreed to from the carrier. That's a big part of the process. And then from a claims perspective, I would just say don't announce breaches for the first time in your underwriting meeting.
Excellent. And so in terms of the current issues, talk us through some of these as they pop up on the screen.
Absolutely. I would say if I was going to put a big red star by one, it would be encryption. I know a lot of you are probably working on a lot of encryption efforts within your company. The underwriters are going to ask about it. And the main reason being, as Tom will speak to, carriers have a common interest with you when they're insuring you. If you guys are encrypting data and that data gets lost and it's not usable by the person who takes it, you can have a potential safe harbor from a legal perspective. So they're going to want to know where and what you're encrypting with your data. I know this is a shocker after Target. They're going to ask about point of sale systems. That's an area that they're diving into, especially the last few months. They're going to want to know about your vendors, your contracts, how you're working with them, what you're sharing with them.
They want to know if your HVAC vendor can get into your payment environment.
Exactly. Even things like, and goes to their trying to understand your process. When you acquire a subsidiary, what's your process about bringing their system into the same compliance standards that you're using at your company? Actually, Lori and I both work with a company that had a fairly large breach at a subsidiary. And everyone knows and the underwriters understand that it's a process that it may take a year or two before we can bring them up to your standards, but they're going to want to know that that's in place and that you're taking care of that, because we've seen breaches happen at subsidiaries when they've been acquired by a company and they don't have the parent company controls.
So moving on, Let's dive a little bit deeper into this, the safeguard controls. We touched on the headlines, but Winston, talk to us a bit more from your experience, what you're seeing in terms of these different categories of risk management.
Yeah, I don't think any of these safeguard controls are going to be a shock horror to most of the audience. These are the sort of standard things that should be everywhere. And in fact, in many cases, when we're dealing with insured clients, the questionnaires that they've been asked to fill out when putting together to get insurance, has been a good wake-up call to some companies, and in other companies are kind of, this is pretty low-hanging fruit. We already had this. I think what's conceptually, though, interesting, especially with insured breaches, because they'll be going through this with a fine-tooth comb, but breaches in general, is that when dealing with a forensics firm that comes in after the fact to decide on what's happened, we're really not interested in the sort of standard CISSP stuff, confidentiality, integrity, accessibility. We work with brilliant IT departments and brilliant network vendors, but we have to explain and forcibly make them wear another hat, which is really what we're interested in is, did somebody get in? If they got in, did they get into the room containing the money? And if they got into the room containing the money, did they get out again before the police arrived? It's a historical view. And we deal with all the time organizations who are dealing with microseconds, especially with large networks. Load bearing, load balancing. They can tell you exactly what's happening across an amazing nationwide network in seconds, but we're dealing with breaches where the problem arises months later. A third party will come up and say, we think there was a breach because something happened. Tell us what was happening to your network 6 months ago. So a lot of the safeguard controls are very now-facing, designed to prevent something, which is great. But since something will happen, are you able to see what was going on 6 months ago? And as Tom said, the size of the breach, it dictates fines and fallout. But in a lot of cases, what's going to bring the regulatory fines down is being able to prove that you took reasonable steps. You were not the slowest antelope in the herd. You were taking reasonable best practices. If you can't prove that, you're hosed.
So it's really about keeping the evidence and preserving the processes and what measures were in place at the time of the breach.
Exactly, but also using those for your baseline so that you can start adopting them as the proof of, is this a strange thing we're seeing? And quite often when we're parachuted in, hopefully to work with a willing, cooperative IT group, we're shown a very small set of data, and our first question is I have no idea. Is this bad or good? Is this spike of activity from the Ukraine terrible, or do you have a business partner in Kiev? I have no idea. Can you explain this to me? So a degree of historical backsight is important.
So then, those of you can see, there's one more cartoon which I think illustrates the issue of the processes once more. But Winston, you've come across this issue with pet names, have you?
Yeah, there's actually a pretty good list out there if you Google it of password guessing, and dog names are like the first 200 or 250 names with one instead of I and that thing. I think Fido and all this kind of stuff. So it's you'll have to get a more inventive name for your dog.
So when you're thinking about the risk management involved, and I realize obviously that from the broking point of view, you guys may be seeing it at the front end, but you see the aftermath of whether or not these have been effective. What are you seeing, Winston, when it comes to dealing with the issues relating to money on IT or money in insurance?
Well, unfortunately, it's a both. It's not one or the other. I mean, the good news is that just putting together and going through the process of looking into cyber insurance is going to makes you a better organization. It's a time to think about things, and I have no vested interest in selling cyber insurance. But companies who've gone through the process of getting cyber insurance or thinking about cyber insurance are by definition, going to be better prepared. So, that's a benefit. There's also some risks which they'll always be there. Target had just purchased a $1.5 million SIEM, and it did not protect it. So there is an element here of however much you spend on IT, your risk goes down, but plateaus out at some point.
So there's always a residual exposure, and I think that's the key part, is that insurance is only a piece of a puzzle. It's not instead of all of the effective network tools, but it's to fill in that last residual gap. So Tom, maybe in terms of the actual breaches, thinking about the personally identifiable information, which I think for this audience is the most critical aspect of the information assets. What are you seeing in terms of the actual claims handling and the most effective responses to the situations as they arise?
Sure, and I think it's not a surprise that breach response starts way before there is an incident. I think the most successful companies in responding to a breach have done a lot of work prior to there being a breach. I mean, I think from a claims handling perspective, I think there are a couple of things that really do help a whole lot. One is to identify. Organizations really should identify decision makers that are going to have the authority to make decisions when there is a breach. I mean, I think that might be an obvious one, but I think it's harder to implement than you might imagine, depending on the corporate culture. I can tell you that when there is a breach, when there is a blogger that's threatening to go public with an incident within your organization within 12 hours, that is not the time to organize 3 conference calls to determine which department this response should sit in. So I think you really do need to have a couple of individuals. I think the smaller the group, the better. That have the authority to make decisions. Vast majority of the decisions that an organization will have to make is to decide vendors, decide the external resources that you want to leverage to respond to a breach. So I think having some of those vendors, having vetted some of those vendors prior to there being a breach really does help in the process, and to really limit the response time as much as possible. I think absolutely claims handling is not just lawyers. I think within the industry, at least in the insurance industry, there was a lot of conversation early on about whether who should be the first contact, right? Should it be the forensics guys or should it be the lawyers? From an insurance guy's perspective, it should be your insurance carrier. That never happens, but I think at this point, I think we've come to some sort of consensus that you should really at least contact the attorneys first, because a lot of the investigation that takes place can be protected by attorney-client privilege, and that can be very critical in limiting your third-party exposure, which can be significantly greater than your first-party cost.
And so just to pick up on that point, on the broking side, you guys are not just there to place the insurance, but you get involved if there's an incident as well. Laurie, have you had any experiences of claims? I imagine you would say that the broker should be the first person they call.
Well, and then we'll call Tom, but yeah, I mean, making sure that everybody in the process knows that you have insurance is one key. I mean, we encounter this with insurance all the time, where risk management buys the policy and then a breach is happening and nobody's told them. So a big part of this is understanding what's the breach response plan, what's the internal communication, and when are the right parties going to get brought in. And then as part of that, have you pre-selected those vendors and organized all of who is going to be contacted depending on the seriousness of the breach.
One item to add on that, Ollie, is Lori and I spend a lot of our time, as all of you out here, you have trusted advisors that you work with, and then making sure, do we have the carrier's agreement if those costs come up in a breach, that those costs are going to be picked up, because a lot of the carriers have developed relationships with outside vendors who may not be the people necessarily who you would want to call. So you want to make sure you have that meeting of the minds, that whoever's going to be that when the bat phone needs to ring, that you have them agree to, so those costs that you spend on those outside investigators gets picked up by the policy.
And that may be something that dictates who we place the policy with. So as we meet with you in the months leading up to placing the first cyber program or to renew the cyber insurance program, is to make sure that if you're using a particular vendor, that we match you up with an insurance company that's going to be willing to work with them, so that all of that gets headed off.
Excellent. So then, just thinking in very high-level terms, as a very rough timeline of what might occur. I mean, Tom, you've obviously lived and breathed this. You want to talk us through the different issues as they arise post discovery?
I think in the interest of time, I will go very high level here. I think we listed some of the buckets of service that you might require in the event of a breach. Obviously, forensics is one consideration, but I can tell you again, privacy events, privacy coverage, cyber coverage is much broader than network security. So how often do you actually retain a forensic expert? Obviously, if it's a network security issue, 100%. But again, in the overall scope of the incidents that we've seen, we probably retain forensics between 30 and 40% of the time. I think one thing that I do want to highlight, and I think this often gets missed during the breach response process, is you really do have to pay attention to the boring stuff, which is the stuffing the envelopes and sending out the notifications, the call centers, and also offering some type of identity theft resolution. Why is that? Well, all those services are external facing, right? Those are the guys that are actually talking to the affected individuals. Those are the guys that address the issues, the live issues that affected individuals are facing. So there's a lot of and again, I think just to back up a little bit on the notification side, it's much broader and much more than just stuffing envelopes and sending out letters. There are return mail management processes that they have to go through. They have to be able to collect the data from the forensics, transfer that data, and to create a manageable list in order to send out the letter. So I think all the boring stuff that people kind of forget about, that is where a lot of my attention, a lot of my focus is, because if something goes wrong in that process, it can have a huge impact on the organization, huge impact obviously on their insurer and carrier as well.
And I guess that's where keeping the regulators happy is a critical part of it.
Can I chime in there, Tom? One thing that with a lot of our clients, depending on the type of relationship you have with your customers, you may deal with them primarily by email. And so we do have a lot of clients who have been able to notify customers of data breaches by email. One thing that I'm watching to see if we'll see any regulatory pushback on that. There was a number of reports after Target did a lot of their notifications by email that there were phishing emails, scams that led to further fraud coming out of that breach. So you could envision a time where that will not be an easy, cost-effective solution for companies, because then you have to go partner with somebody who has your customers' physical mailing addresses if you don't, to be able to notify them of a breach.
Absolutely. So then maybe if we've talked about all the things that can go wrong, maybe let's focus on what can go right in the event of a breach. So Winston, you're parachuted in. What happens next?
Well, the planning has to have already happened. So there has to be an incident response plan. And more importantly, it has to be a plan that's focused on resolving some of these issues that are going to arise, the regulatory problems, the enraged customers who've been misinformed about something by a bad press release, politicians who are up for election and are going to thump their barrel and come down hard on somebody. These are things which are counterintuitive a lot of times to IT, who's thinking of incident response plan in terms of disaster recovery. So there has to be a good plan. It has to have been practiced. It really has to have been practiced. One of the issues we get is, and I think somebody on the panel referenced that it has to be somebody with the authority to do something, somebody who's got the authority to make decisions, a group of people. We quite often get the situations where we ask for a piece of data or we ask for something to happen, and there's a sort of degree of head nodding, and it's a stupid question gets a stupid answer. We'll ask, okay, give us this piece of it. Have you got this data? There's a nod. Could you give it to me? It doesn't exist. Okay, which point where were you not going to tell me that data doesn't actually exist, or where are you just going to keep nodding your head? That's the kind of thing that needs to have been run through a drill, a practice. It's torturous. People have other things to do on the weekend than to spend a few hours going through a drill, or a few days going through a drill. The other problem we're seeing is with companies who've outsourced some integral part of one of their applications, whether it's backup or something. That'll be the weak link. That'll be the fact that on weekends, they can't get to that third party. So there's a degree of going through the plan, making sure it's going to work. The other one is just making sure you maintain everything. Again, it's counterintuitive in a firestorm, but it's going to be the regulators who are going to come after you if you can't prove things. And it's going to be the class action plaintiffs lawyers who are going to come in and argue that because you can't prove something, that's the smoking gun. You were highly negligent and you managed to lose that one piece of evidence that proves you weren't.
So that can be the difference between a successful dismissal of a class action and ultimately having to pay a seven-figure settlement, as we saw recently. And so we've got about 10 minutes left, so we're going to try and save a few minutes for questions at the end if you have any. But Tom, these are obviously, you've seen a lot of claims and written a lot of checks. Maybe you could just talk us through some of the trends that you're seeing from your own data.
Sure. I thought it might be interesting to provide an insurance company's perspective on some of the events that are out there. Obviously, there are a lot of reports from security firms, whether it's Verizon or TrustWave, but I think their focus generally is on the network security events, right? Our focus is much broader than that, so we deal with more of the privacy issues. And as you can see from some of the data there, the unauthorized network access events, only make up about a quarter, 24% of our incidents, of our claims. 76% is really something else, right? There's 7% for paper. There's a lot of rogue employee activity that we see that do not, especially in healthcare, and even in retail to some degree, that does not necessarily correlate to a network security event. So I think that's important to keep in mind, and I think this is something that organizations really should wrestle with when they're deciding, how they're going to implement their organization security structure. Should it sit with IT only, or should it have a more just broader responsibility within the organization? I think just one thing that I do want to highlight, moving on.
Oh, sorry.
That's okay. I think, depending on the industry, I think we kind of touched on this before. It's, depending on the industry, you really do see different types of triggers. So, for healthcare, for example, in healthcare and retail, you do see rogue employee activity there, but rogue employee activity means completely different things in healthcare versus retail. So in a lot of the healthcare situations, you see employees, accessing medical data, medical information for, non-financial reasons, just because they're curious, because it's related to, a family member or somebody's boyfriend, or we've seen a lot of that where they access, their friend's boyfriend's medical information to,
Don't forget the celebrities as well.
Oh, yeah, absolutely, and the celebrity. So you see a lot more of those types of access events in healthcare. Although obviously, we do see some of the network security incidents in healthcare as well. Whereas retail is much more financially driven, right? So you see a lot of the skimmers, handout skimmers, where they're capturing credit card information. So I think you do have to understand the exposures, the risks, depending on the industry that you're in. I think this one is, again, I'll go over this very quickly. I think this is an interesting slide. I think I get this question all the time. So how much does it actually cost based on the data that you have? I did mention that network security events are only 24% of the claims that we see, but it's more than 50% of the actual payouts, because I think in a network security event, you do have to engage Winston for forensics. You generally do have to notify and have to incur all the buckets of service that generally are required in a privacy incident.
So a quarter of the number of claims is generating more than half of the claim dollars paid.
The network security event, yes.
Interesting.
And I think, again, a lot of times you don't have to engage every bucket of service, depending on the type of incident it is. For a network security event and that involves PII, you generally do have to engage every bucket of service. So I think I did include the Ponemon studies. I think those are good numbers for organizations. I think it does give them some type of benchmark, but for insurance purposes, it really does not apply. The Ponemon numbers obviously includes some of the non-direct expenses as well, including reputational damage, reputational harm, and so forth, which again is generally not going to be covered under an insurance policy for data breach response.
So everyone knows what spear phishing is in this room. Talk us through what happened in this incident.
Sure. I think many of the incidents that we do see involve a third-party vendor. there is about a third actually of all of our incidents involve a vendor, whether we are insuring the vendor or whether we are insuring the data owner. One of the incidents that we've seen, this particular one combines actually the vendor and also a spear phishing incident. So a spear phishing attempt actually compromised a vendor. They downloaded a payload malware, which resulted in a compromise of the data owner. So a breach at the vendor caused a breach at the data owner. I don't know if that sounds familiar, but it's not Target. But we've seen this type of situation a number of times prior to Target and even subsequently.
And that was 7 figures, it looks like. Well,
This one was 7 figures, and I think this one actually involved the whole entire gamut. You had to get legal, you had to do the forensics, you had to notify people, notify clients, and because the client also suffered a network security event, there was a network security, network liability third-party claim as against the policyholder. So this actually ran the entire
And
gamut.
this is exactly why we're talking to all of our clients, and our clients are being asked by their customers, do you buy this cyber insurance? How much are you buying? It's starting to be written more standardly into contracts because when a vendor causes these types of losses at all of their clients, then they're coming back to them looking for recourse.
So then the second example looks like it was a physical hardware that was actually compromised.
Yeah, actually the next two, we can just go over very quickly, but this one was actually a skimming device that was placed on top. I think with the advent of 3D printing, you can 3D print these devices that you can lay over the payment card or the pin pads. And that's exactly what happened here. It happened across many different stores, many different states. But one thing I do want to highlight from this event, although this is a retail incident, there was no PCI fine. There were no notification costs because retailers generally don't keep the data, the personally identifiable information for retail transactions, and there was no credit monitoring offer for the same reason. So even though this was a large event, it actually did not result in a huge payment relatively on the first party side. That said, obviously on the third party, there are class action lawsuits, and the defense alone for these litigation lawsuits can be very expensive.
So then the last example is a nice segue to one of your clients that actually did suffer at the hands of the PCI
Right.
regulations.
This was relatively early on, and I think one thing I do want to highlight is that the fines for failing to comply with PCI DSS is relatively minor relative to the assessments and the fees that can be charged against a merchant. But a continued non-compliance with PCI DSS can add up very quickly, and here it almost resulted in $500,000 in fines for continued lack of PCI DSS compliance.
So we just have a few minutes left. Final call for, are there any questions for any of the panel on any of the topics covered so far? In that case, going once?
Is that one?
Going once? Oh, sorry. Yes, sir.
Mike Joseph, Google. You talked a lot about incident management and mitigation, and mitigation after an incident. You also talked a little bit about auditing, but what in general is your industry doing to push for enhanced security amongst your customers and your insured? Because I do wonder if there's, and obviously you can reduce your insurance liability by reducing the likelihood of a breach in the first place.
Sure. So from the underwriter insurer perspective, I can certainly answer part of that question in the sense that what are we doing? I think that the bar is being continually raised. So what was acceptable 5 years ago is no longer acceptable today. Whether it's encryption standards or regulatory compliance, and clearly it's a very dynamic environment, both from a regulatory perspective and from a technical, technology defense perspective. But each year, as our product and our comfort increases, we can raise the floor, if you like, and our expectations get higher in terms of what is the minimum baseline that is acceptable in order to procure insurance. I don't know if any
I mean,
additions?
to add to that, I would just say, I think it is challenging for insurance underwriters to make judgments about technology decisions that you are all making. I mean, you guys are the experts in this space. A big part of what we're trying to do is talk to clients about the people and the processes that they've got in place to respond as things like, the Heartbleed vulnerability came up earlier this year. How quickly were companies able to respond to that and patch their servers and upgrade their code, or even whatever you all say. And that's the kind of underwriting that we're trying to do, is to figure out, are people ready to respond to the changing environment? I think there's another question.
Yes, there's a question in the middle.
Sandy Murphy, Parsons. You mentioned Heartbleed, that's the subject of my question this morning that was mentioned, and you also mentioned that login and passwords have become considered PII. The initial reports said that when the vulnerability was discovered at OpenSSL, their internal tests showed that a successful exploit left no traces. So nobody could tell whether the vulnerability had led to a breach. And people were encouraged to wait until they were told that their business that they were doing business with had patched and then changed their password. What's been the regulatory response to the possibility that breaches that could not possibly have resulted in a trace could have occurred? And what's the insurance company's response?
Maybe, Winston, you want to start on that one?
Well, I cannot talk about the regulatory side. However, on a no-names basis, I have been approached by 2 plaintiffs' attorneys asking how they could prove liability through Heartbleed. And it requires a degree of mathematics of, a password that was used only after the vulnerability could have arisen and then wasn't used again, and this kind of stuff. I think the general consensus is that they would move on to some lower hanging fruit, maybe asbestos or children swallowing small toys or something like this. And this was way, way too much work for somebody who barely graduated from college. So that would be my take on it. But what the regulators are doing, I have no idea.
I think it's a wait-and-see approach from the insurer's perspective, which is probably not the answer you're looking for. But right now, we're still...
I actually expected that the answer was going to be the insurance companies would decide there's just no way, and they were going to throw up their hands and say, we can't deal with this.
It's in the too complicated bucket, I think. Certainly, it's a challenging issue, and given the breadth of the potential exploit, the scope of it is certainly one that we're still looking for ways to identify that we can prove against it, rather than, right now the onus is on the plaintiff bar to come to us and our clients and say, this is a specific correlation with you. So at the moment we'll wait and see.
I would just quickly note that the regulator's authority comes from statutes, and vast majority of statutes say a breach is an unauthorized access or acquisition of information. Unless and until you can show that, your obligations under some of these statutes do not get triggered.
Okay.
Thank you very much. I think we're out of time, unfortunately, so I'll leave you with 2 final quotations. One is from the CEO of Zappos. He said, we spent 12 years building a reputation, brand and trust with our customers. It's painful to see us take so many steps back due to a single incident. This was the incident last year he's referring to, where 24 million username credentials were exposed, and certainly highlights the importance of brand and trust that comes with maintaining network security. And then my final comment is that obviously preparing for when an incident takes place will put you in a much better position if it does take place. And that is, I don't often quote Mike Tyson. He says, everyone has a plan until they get punched in the face. Thank you very much.